Macroeconomic factors have strongly affected a country's economy, where their meaning itself is a factor that influences the economy of the country and also a factor that contributing to the stock market returns and develop relationship between macroeconomic factors and the stock market. GSE market returns reveal it have a strong positive relationship in the long run with inflation, but not strongly significant in the short run. A significant amount of unemployment rate will result in implementation of monetary policy. For the broad money, it has a positive effect on stock market returns. The stock prices are affected by short-term fluctuation in the money supply, changes in interest rate in a positive way, and inflation and foreign exchange reverse are inversely connected. Macroeconomic factors have a wide impact on a nation. How are these factors in Malaysia influence the market stock return? A few macroeconomic variables has been selected as a measure of a macroeconomic impact towards stock market return. This research is mainly to find out the reason of increasing in retail participants in Bursa Malaysia when the retail investors continue to be a large percentage of Malaysia equity market participants. This research also includes the unemployment rate where it can affect the stock market return. Most are well aware with the existence of the stock market that leads to the pricing of local retailers' participation in stock market, where it is also an indicator of consumer spending. By using market capitalization, the relationship between selected macroeconomic variables and stock market return will be compared to test whether it have a meaningful impact on stock market return or not. There are 5 research questions RQ and 5 research objectives RO, which are being discussed about the relationship between macroeconomic variables, which are inflation rate, gross domestic saving, real effective exchange rate, broad money, and unemployment rate towards the stock market return. Move to the hypothesis statement for HO1, HO2, HO3, HO4, and HO5. There are no relationship towards stock market return, while for H1, H2, H3, H4, and H5, there are relationship towards stock market returns.
The dependent variable of the research is market capitalization, which is a measure of the stock market return, while the independent variable use the selected macroeconomic factor, such as inflation rate, gross domestic saving, real effective exchange rate index, broad money, and unemployment rate. There are several results from previous research regarding the market capitalization as a measure of the stock market return concept. Example from Kumar, which stated that economic growth is normally correlated with capital formation and also has a positive impact on market capitalization by encouraging faster growth. Other result is from Njomba, which found that the exchange rate and interest rate have a significant effect on the market capitalization in Kenya. Previous research of inflation rate on stock market can be found with research by Norihan and Rizwan, where they stated the inflation rate is significant and positively influenced the stock market return in Malaysia. However, research from Fernando showed the impact of lower inflation on stock market was negative, while Coffee discovered there are strong positive long-term relationship between inflation rate on Ghana's stock market returns. For gross domestic product or GDS, the research by Shahbaz et al. Show a favorable outcome demonstrate the impact of domestic saving on stock market capitalization, differ from research by F. Norehan, which found that the Malaysian stock market have been unaffected by domestic savings. The research from Yati show insignificant between GDS and stock market return. For real effective exchange rate index, research by Charles et al. Revealed that stock prices and the exchange rate have a long-term relationship. Same goes with research by Jane that show the between USD and India rupee exchange rate and the India stock market. The research by Engel also show a link between the exchange rate and stock market return. There are some previous research that see the relationship between broad money and stock market, as research by Mohammed and Ahmed stated that money supply has a statistically important effect on stock market in Jordan, while research by Cardi said both relationship is proportional. However, research by Norehan and Fernando show that negative and no relationship between stock prices and money supply. For unemployment rate, the previous research from Argument et al. Stated that only employed person can contribute and invest in the stock market freely. Research from Boyd said the relationship between stock market activity and unemployment in the country is significant, since unemployment has long being seen as a reliable indicator of an economy's health, and more recently as a very accurate predictor of stock market behavior, particularly in developed stock markets. As from Gonzalo, research said increase in unemployment rate which result from implemented of monetary policy will cause the stock price will increase stock market return. They also stated that there is no clear scientific study on the impact of jobless on stock market returns.
A research framework is a structure that may support the theory of research to help the readers to have better understanding and clearer image of what the researcher trying to deliver in the research. The goal is to measure the significance relationship between independent variables and dependent variables. Moving on to methodology. Data collection method. Firstly, World Bank Open Data. It is a database of time series data on a variety of topics that can be visualized and analyzed. Next is EViews. EViews is an econometric modeling program that allows the construction of statistical and forecasting equation. And lastly, Thomson Reuters data stream. It gives access to knowledge related to macroanalysis, asset allocation policy, and sector research through financial market database. For data analysis method, firstly, descriptive analysis. It functions to arrange and summarize data collected by explaining the relationship between variables in a sample or population. For correlation analysis, it is a technique of finding the relationship of two sets of data or variables. And lastly, regression analysis. It is a statistical technique used in the attempt to explain the changes in dependent variables as the function of changes of independent variable through quantification of a single equation. There are few rules of thumb for descriptive analysis. Firstly, for skewness, if the data is in the range between -2 to 2, it is considered normally distributed data based on George, Darren, and Mallory P. For kurtosis analysis, the data is normally distributed if it is in the range between -7 to 7, said Brian B.M. And for the probability of Jagbera, it should be more than 0.05, which shows the significance level, where if the result is more than 0.05, it shows that the data is normally distributed and fails to reject the null hypothesis. For the findings of descriptive analysis, all data shows normally distributed data in the range of -2.2 except for broad money with -2.2266. And for kurtosis analysis, all normally distributed data are in the range of -7 to 7 except for broad money with 7.7660. And lastly, the probability of Jagbera for the variables show normally distributed data with more than 0.05 except for stock market return and broad money with p-value of 0.0000.
Let's move on to correlation analysis. Based on the table, the economic factor of stock market return includes the inflation rate. It shows inflation rate has a very weak positive relationship with the dependent variable, because the value is 0.182199 and it is below 30%. For the t-statistic value, it shows that the value is 0.980516, and for the p-value it is 0.3352, which it is above the 5%. It shows that it has a significant relationship with a dependent variable. For the gross domestic savings, it have a very weak positive relationship with the stock market return, since the value is 0.14656, which is below 30%. And for the t-statistic value, the value is 0.784003, and for the p-value, the value is 0.4396, which it is above 5%. It shows that it is an insignificant relationship with the dependent variable. For the real effective exchange rate index, it shows that it have moderate positive relationship with the stock market return, since the value is above 30% and below 70%. For the t-statistic value, the value is 3.524771, and for the p-value, the value is 0.0015. For the broad money has a very weak negative relationship with the stock market return, because the correlation value is
negative 0.029175, and it is below 30%. For the T statistic, it has a negative relationship between the stock market return and broad money because the value is negative 0.154443, and for the P value, the value is 0.8784, which it is above 5%. It shows an insignificant relationship with the dependent variable. For the unemployment rate has very weak positive relationship with stock market return because the correlation value is 0.028406. For the T statistic value, it is 0.150370, which it shows a positive relationship between stock market return and unemployment rate. And for the P value, the value is 0.8816, which it is above 5%. It shows an insignificant relationship with the dependent variable.
Moving on to the regression analysis. Based on the coefficient, we found that only 4 is positively related to the stock market return, which is inflation rate, exchange rate, broad money, and unemployment rate. Gross domestic saving is negatively related to stock market return. Based on the probability value, we found that only 2 have significant relationship to stock market return, which is exchange rate and broad money. The other 3, which is inflation rate, gross domestic saving, and unemployment rate, is insignificant. On to the next slide, which is our finding on the result. We use regression analysis. For research objective 1, since we cannot reject the null hypothesis, there is no significant relationship between inflation and stock market return. This is backed by a research conducted by Karki, which reveals stock market return shows similar result, which shows the inflation rate is positively related to the stock market return, and by Shahbat that says the inflation has an insignificant relationship in stock market return. Research objective 2, we cannot reject the null hypothesis, hence there is no significant relationship. This is backed by a research conducted by Ali et al. To 2015, which resulted in GDS have a negative relationship with stock market return. A research by Paul K. and Mittal R. GDS and India capital market have insignificant relationship. For research objective 3, the null hypothesis can be rejected, hence there is a significant relationship. This is backed by a research by Kibria that says exchange rate has a significant relationship to stock market return. Same goes by the research by Kofi 2018 that found that there is a significant relationship between Ghana exchange and exchange rate in the long run and the short run. The next research objective is research objective 4. The null hypothesis can be rejected, hence there is a significant relationship. This is backed by a research by Hussein that the money supply showed a positive and significant relationship with stock prices, and a research by John E.I. found that the money supply has a significant relationship with stock market return. For the last null hypothesis, research objective 5. Since we cannot reject null hypothesis, there is no significant relationship. This is backed by research by Agirman 2019 that has proven that the unemployment rate has a positive impact on stock market return during economic expansion. And a research by Singh T. Mehta 2011 revealed that the unemployment rate does not have a significant relationship with stock market return. So last but not least, based on our research, we recommend the next researchers to add on macroeconomic variables with a significant relationship, not necessarily be our variables, and they can also add non-macroeconomic variables. Do not fix it into macroeconomic variable only.